Okay, so I wanted to create another video, actually an updated video on how I do my chartings, what indicators I use, what time frames I use, and how I place my support and resistance levels. To me, support and resistance levels are pretty much like a roadmap. Without them, you'll be lost. You wouldn't know which direction things are going in. Support and resistance give you a better understanding on where to place your entry and where to place your out. I'll give you a couple of different examples on, especially with oil. I'll give you a couple of examples on what I look for on good entries and what I look for on, shorts, longs, and to short it, and so on. And then also I'll let you know about the different indicators that I use, moving averages that I use on different time frames. I use a lot of moving averages, probably more than what a lot of other people would use. As you see here, I have the 20-day moving average, I have the 50-day moving average, I have the 100-day moving average, I have the 200-day moving average. I use these two the most: 100-day moving average, 200-day moving average. That's like my pride and joy. I love those two moving averages. They help out a lot in a big way. Also, the smaller indicators that I use on other time frames, you'll see the 7-day exponential moving average, my 30-day moving average, my 26-day exponential moving average, the 19-day exponential moving average. The 6-day exponential moving average pretty much cancels out because I actually use the 7-day. The 7 is actually a better indicator than the 6. The 19 I really don't use too much, but I'll explain how I have these different moving averages in here and how I can how I can differentiate, I think I said that wrong, between the different moving averages. So let's get into that now. Alright, so let's start on my favorite currency that I love to follow, which would be USD/JPY, better known as UJ for short. That's what I call it, UJ. Okay, so here we are on the minute chart. Actually, let me switch to, alright, here we are on the minute chart. Here you see the 200-day moving average, that's the red line. Here you see my 100-day moving average, that's the blue line. The other moving averages, the exponential moving averages, these I really don't pay too much attention to on the 1-minute chart because they really don't help me on the 1-minute chart. The 1-minute chart moving averages that I use the most when I'm looking at the 1-minute chart would be the 200-day moving average, the 100-day moving average, the 50-day, and also the 20-day. So I'll use those a lot. But of course, 100-day and the 200-day I use the most. So as you see here, as the stock was trending after 2 o'clock, these dips below the 200-day moving average, and trying to hold above the 100-day moving average. You see across here, it's going down. I mean, I like these, as you see how it hits this 200-day moving average as resistance, going back down and then coming back up. How I determine my pops as well. This is how I determine my pops. This dip below the 200-day moving average. See how we retest trying to go back above the 200-day moving average. We tried to retest the 200-day moving average, trying to go back above. Now, also, I I know I said that these don't really play a role in the 1 minute, but let me explain this 26-day moving average, the exponential moving average. The 26-day exponential moving averages acts like the 200-day moving average, because my 200-day moving average is like the make or break level. This also on longer time frames acts like my 200-day moving average. So I do use that and combined with a lot of the other moving averages. So as you see here, as we get into a squeeze, after we couldn't break above the 200-day moving average, we get into a squeeze. You see this line here? This dotted line is my 26-day exponential moving average. I highlighted it, I'm sorry, not highlighted it, but I colored it, the color with the amount of thickness that you see. So you see that thickness in that line, because that's how important this indicator is to me. But you see how it held USD JPY from going lower. As we get into a squeeze right here, that's where your pops come from. Those are the pops that you'll see me post. I'll try to get in sometimes as little as $10, $20 at the most. I'll get in at 60 and try to close out at 90. But you could see some really good pops with that type of an indicator. They also work well on the 5-minute charts as well. The other time frames, maybe the 1-hour charts, but you really find it more on the 1-minute charts than you do with any other time frames. The 1-minute charts, I love the 1-minute charts. I use those for my entries and my outs, you know, based on support and resistance. But just to show you how I determine my pops, that's exactly how I determine my pops. Now, to explain the other moving average, the other exponential moving averages, this set of moving averages, let's flip to the 5-minute chart. My 5-minute chart, sometimes when one of these currency pairs are trending like up or down, you'll have a nice fan effect. And what I mean by a fan is the moving averages will fan out, and it looks really nice to actually see. But that break of that fan going higher and breaking this all-important dotted line here is almost like a trend reversal, but it's also a good way to enter into a long, you know, a long on a reversal, and taking it as high as it goes until you find a spot where it will reverse at. And we'll try to go over some of those things too. But look at the 200-day moving average on the 5-minute chart as well. So you see, couldn't get above there, couldn't get above there. On this next touch, I usually call it 3 touches, usually 3 touches, and either the 3rd touch or the 4th touch will produce a pop. Rarely have I seen these things linger for longer than 8 hours. I actually saw it for the first time linger for more than 8 hours on, I want to say that was Wednesday. I've seen it linger for like 8 hours. Like, I was expecting a pop, and I'm usually within an hour or two of that pop, but this pop took at least about 8 hours to actually produce. I wish I could actually show it here on the minute chart, but I can't, because on freestockcharts.com, or I should say TC2000, I can only go back probably 2 days, only 2 days, so Friday and Thursday. So I can't go back to Wednesday, because I think that's when it happened. Yeah, so I can't go back that far. No, I'm sorry. Because this trade's 24 hours, I can only do about 24 hours. So I can't go. I think that was on Thursday, maybe Thursday or Wednesday, one of those two. But just want to show you how these moving averages take a hold and take effect. Zoom in a little here. Okay, so the exponential moving averages, I dot those so I can separate them from my other moving averages. As you see, I have the 19-day exponential moving average. I have that green because that actually acts like my 50-day moving average, and then so on. I have my 26-day. Well, of course, my 26 is actually my my 200-day, and then we have the 30-day moving average, which can actually act as the 200-day and 100-day, but it does play a role in how I trade and what I look for. But the dotted lines definitely for sure. The 7-day exponential moving average, I don't have it dotted, as if you remember me saying, the 6-day actually cancels out. It's actually the 7-day. I actually left these two on here just so I can see the difference in between how stocks trade between these two exponential moving averages. And as you see, it's really tight. The 7-day is a little bit looser than the 6-day, but you can use either one. I like the 7-day. It's actually helps me a little bit better. But as you see, trending down, the 7-day. This right here, remember, like my 200-day moving average. Even though we have the 200-day here, but this is like my 200-day moving average. But a trend holds below this exponential moving average, as you see here. Holds below, comes above, but the trend does not hold long to this area, and then back down. Let me move the chart. Holds above, comes back below. Now 11 o'clock, usually that's well, not 11 o'clock, but usually around 12:30, 1:30, you'll see some market turnarounds. So on here, 11 o'clock, after 11 o'clock, a nice jump to the 200-day moving average. You see there, to 1 o'clock. So that was, some good longs. Long from 11 p.m. up to 1 a.m. So as you see here, that's how my moving averages work out. I use these a lot. I use them a lot in different time frames. Now I'm on the 10-minute chart. I still use all the moving averages. Look at the 200-day. 2. There's your third test to the 200-day moving average. Now we should see on Sunday possibly a pop over this 200-day moving average. Once we pop, then we look for resistance levels. So let's go on to the resistance and support lines that I actually draw, and how I make my determination on where to actually place those resistance and support levels. So my resistance and my resistance and support levels come from previous price action. I do not use the Fibonacci's. My personal experience, I don't use them because I draw my own levels, and actually when I draw my own levels, if I match them up to the Fibonacci's, it actually matches up almost perfectly. So the Fibonacci's, the currencies trade on the Fibonacci's, but I make my own levels because there are different levels other than what Fibonacci can show you, that have good impact on how the trend or stock goes. So we can make my first line here. Right. Yep. Now, how do I determine where to place it, and why didn't I place it here? So why didn't I place it here at this top of this approach? Now, there's not a right and a wrong answer for this. You can actually place them in any location that you wish, because the stocks or the currencies usually trend either right below it or right above it. I mean, you're not going to be perfect all the time, but you just really want to be in a general area of where you see a lot of pricing action at. And the reason why I chose that level instead of the higher level is because of all the touches. And let me show you the touches that I'm talking about. We have this touch here. This touch here, of course, it breached above. You see this? That touch there, important to me. This here is important to me because of how it's trending on that line. Here, important to me. Here, important. Let's keep going. Look at how this works. Here, important. Here, important, as it fell down and got right back above this level. As you see how it lines up. Look at that pop there. So that's one level that I would use. My next level, that's on the 10-minute chart. So I mean, you can do this on any time frames. Prefer to do it on the 5 and 10-minute charts, and also 15-minute charts. You can do them on the 30 and 1 hours. But what happens is if you go to the 1-minute chart and actually start placing all these lines, you're gonna have a lot of lines in here. And then once you do that, you're gonna have to kind of clean it up to actually just use the important lines, because otherwise you'll have a line here, 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 here. It'll just look really crazy, and it will confuse you. So you don't want to be confused when you're actually trying to trade. You actually want levels that actually are going to mean something. So let's go into the 5-minute chart. So we're in the 5-minute chart. I'm going to place another one here. Just right about there. And you see how I'm lining that up? I was actually going to place it here, but as I started to move, I noticed how it lines up with some of the other things going on here. And look, it also lines up with how the market ended at 5 o'clock. So I like that level. Now, how far does it go back? All right, that's about it. Now, once you create these levels run with the stock or currency, whatever. They run with the chart forever. So you don't never have to redraw them. You'll never have to delete them. They run with the chart forever. So 117 level can be left behind. It can trend up to 119. Once it comes back in this area, you'll notice that it will still, these levels will still play a significant role. And I do that with a lot of my charts. I try not to delete anything, but what I do is if the lines or if the stocks actually trend back in this area, and I notice that it hits one level more than another level, then what I'll do is I'll color it. So this will be purple, or you may see brown or something like that, but I'll color it to some type of importance that it's more important than a regular white line. So you'll see a lot of my charts that I post, they will be colored, and that's why they're colored, because sometimes that pricing level makes a big price shift, either heavy resistance, heavy support, or so on. Let's go into the minute chart. Alright, so on a minute chart, I mean, we could place some levels here on the minute chart. This was a nice channel here, so I placed it here because of that. This stop here, this stop here. And of course we can't go further back. That's about it on my chart that I can do. Let's go to the 2 minute. See how that works out? That's the 2 minute chart. We chose this level here. A nice dip, a breakthrough of this level. Actually, look, see that 200-day moving average? Stops. And then breaks right here, right at the 1 minute. That's why it's very important to look at all of these different time frames. I mean, I basically in between all of these. 2 and 3 minute, not so much, but I'm basically in between all these different time frames, looking for different levels. But this was a really good one. Look at how my other moving averages come into play. Pop right there, right before 1 o'clock. Well, yeah, small pop before 1 o'clock, and then the bigger pop right after 1 o'clock. Also, another thing that you'll see with some of these pops is most of them are programmed, and I say programmed because it just happens all the time. So it's programmed to actually do it. But most of these pops happen sometimes right after the hour, either right after the hour or right before the hour ends. So you'll see a lot of pricing action, especially if I'm expecting a pop. I might choose a strike price. So like, all right, for instance, I'm looking at this area here and I'm saying, okay, we're having trouble getting above this 200-day moving average. It's now, let's look at the time. It's now 30 minutes before 1 o'clock. What are the chances that we actually get that pop before 1 o'clock? It's almost about 65% chance that we'll get that pop before 1. 12 and 1 are usually your quiet times in the market. So chances are it may pop after 1. So what you can do is you can go into a position where you have an expiration of 2 p.m. So you get in around maybe around 12:30, 12:40 to prepare for that pop. Now, if you happen to find some strikes that are above the pop level at a cheap price, then sometimes it's good to play them, especially if you can get them for $5, $5 or $10. Anything more than that is actually too expensive to actually chance that a pop will happen. Now, another thing is when you're checking for the pops for the next hour, your pricing range you want to look for is between $15 and $40. 15, of course, being on the lower end, because if it actually gives you a tremendous pop, you can actually make a nice income out of that one. So from $15 it can jump up to about 80 or 90 and so on. And especially if the pops hold. If the pops hold above your strike, the longer it holds, the better your premium return, and your return will be off of that $15. So that's what I look for when I look for pops, and my support and resistance lines too as well. The support and resistance lines, once I have those drawn out, those also tell me my good pop levels. So again, just like here, there possibly would have, if I was drawing this out, there might have been a level here I would have drawn here on the 1 minute chart, only because it's right below the 200-day moving average, and I want a early warning system before it breaks above. So I will say here, and then I'm noticing the squeeze here. So of course you'll enter in, you'll enter your pop levels. So I hope I'm explaining this right to you. I'm not confusing you on how I'm doing these support and resistance lines. Now let me go back into the 5-minute charts. Actually, no, I'm going to stay here on the 1 minute. Now, many of you know RSI is my friend. It's like my BFF. I love it. If without it, I don't know what I would do without it, because it actually gives you, of course, it gives you your overbought. Well, let me explain what RSI is. RSI is your relative strength, but otherwise known as your overbought and oversold indicator. Actually, your stochastic is the same thing, but RSI is your overbought and oversold indicators. You know, it's usually 30 is your overbought, 30 is your oversold, 70 is your overbought. So anywhere in these areas, you know, short. Anywhere in these areas, go long. But not all touches of the top and bottom RSIs are tradable. So let me tell it again. Not all of them are tradable. You find yourself into a big hole trying to trade these all the time. Don't do it. Now on the bigger time frames, you have a better chance, but on the 1 minute chart, don't do it. I use the 1 minute chart as my entry. So if at 1 o'clock, let's see, okay, so at 1 o'clock on my 5 minute chart, you see that RSI is at 69.48. The pop that we got here could not hold, in my theory, in my eyes, is because it was really at a ceiling. You know, it couldn't go any higher. Now believe me, the USD JPY can go a lot higher than that 70, and I've charted it going higher than 70. Each currency actually has its top out level that you should chart on your own. You know, chart those on your own. So not all of them are going to be at 70 and 30. I think it's USD Canada, or it's another currency where it's actually at 90 is where the oversold is. I mean, overbought is, and at 10 is the oversold. So I mean, you have to chart them individually. On my phone, I actually have RSI charted differently for USD JPY. I just don't have it charted differently on here. But theoretically, here on your 5 minute chart, this was actually a good short. From here, look at RSI. Going down. Now, if we actually had more time, if the market didn't close at 5, so say the market continued to go on like it does during the week instead of closing on Friday, this line here, or the level that you actually drew here on this level, is actually your target on a bullish run. So of course we got stopped out here. We got stopped out here, and of course you see RSI approaching again to this level. But believe me, sometimes I've seen these happen. You'll get another breach of this area, and you'll get a bullish run to this target here. That can actually be your target to actually sell. So this would be your nice selling target at that area there. Now also, a lot of things that you have to pay attention to with the currencies is they tend to try to retrace and retrace. And the reason why I say retrace and retrace, because once you get a pop up, it'll go back down. It will try to retrace to that first, from the previous high, and then retrace to that previous low. Most of the times you see this a lot, and especially I mean, just like here, you got a pop here, it retraced and tried to pop, get above this pop level. So that was a nice tradable in. Now here we really didn't get a far drop, but as you see here, we got a double bottom here. So this to me would be a nice level to actually draw here. So you have a nice little channel between these three lines here, and actually we got another line here, but you have a nice little channel in between these lines here. So this is a nice tradable zone. So anywhere down here, as it retested here, was a good long, and combined with RSI, as you see here, RSI is at the low. Now RSI did not first touched here on this candle. Let's zoom in here. RSI first touched oversold here. Now why wouldn't you use that as a good entry? Perfect example is because, let's zoom back out. Perfect example on why you wouldn't use this as a good entry is, how this actually did. Perfect good reason why is because look at this bottom area. You want to be at least somewhere close to here before you actually enter back in long. Now you could have missed out on this, yes. I mean, again, here this was actually tradable. This was actually tradable. But what if you saw it here 3 times and then you said, oh, okay, well, it's going to do it again. It's 3 times. It does not happen all the time. Now granted, you could have done this. You actually could have gone in here and it did not reverse on you like you wanted it to. So you could actually enter in again to actually cover your loss and actually make more gains. So as you see here, we got that bottom here, matches up with this area, take it higher. There you go. And that was actually from 117.39 all the way up to 117.96. So that was actually a really nice run. Yeah, really nice run. So that's how you use the support and resistance levels, and you combine them with RSI and your moving averages, and you'll actually have a nice trading arsenal to actually try to duck in and out of these stocks. Now long-term trades are a lot harder. I'm still trying to still trying to find out the best way to actually trade those. We actually had some success Thursday and Friday on doing long-term trades. So I'm actually 2 for 2 on that, and hope to continue because a lot of people in the group actually wants longer time frames to actually trade on. So right now the time frames that we're trading are about an hour, hour and a half, no longer. But I'm trying to make it longer for a lot of the other people who can't duck in and out of stocks that quickly. So I think that's about it that I have to show you with my moving averages. Give me a second. I'm actually going to pull up oil, so let me pull that up and I'll be right back with you. Okay, so unfortunately I'm on at NetDina, which is actually what I use for my phone. NetDina does not want to. Oh, it's coming up. Maybe, possibly. Alright, let me pause the video. Okay, before we get into the oil chart, I just want to go over my trading platform of what I use to trade with before I show you the oil. So let me show you my arsenal of stocks or currencies that I actually trade, and I trade these all together. I watch them all together. So on my platform here, what I have here is I have my one screen, what actually gives me a bigger overview of the one currency. So now when I'm trading these and I need to look at something on a bigger scale, a bigger picture, different type of chart, because I have different moving averages, so of course I see them here. So what I also do is, this is where I actually start from. I start here, and I start here because I watch all of these simultaneously. These two follow each other, so Euro JPY, USD JPY, those two follow the market. So if the market is going higher, these are usually going higher. If the market is going lower, these are usually going lower. So I watch these two simultaneously. These three are in reverse. So if these are strong, these are if these are bullish, these are bearish. And again, these are bearish, these are bullish, these are bearish. No, I could have picked some other currencies, but again, the only reason why I chose these 5 currencies because I like the movement and the volatility that's in these currencies, as well as NADAX trading them having hourly expirations on them in the PM. So that's another reason why I actually follow these, is because of that. They have hourly expirations for all of these. NADAX may have added more lately, but I haven't checked because I'm more than happy with what I have here. I don't need to trade 20 different ones just to get the results. I mean, I find good results with these 5. The ones I trade the most between these 5 would be USD JPY, of course, Euro USD, AUD USD, and sometimes JU. And I trade them differently because of certain things. JU makes huge swings. So as you see here, you can't really see it here too much, but I mean, it makes huge swings. Now, just because it makes huge swings doesn't mean that you can actually potentially make more money in it, because with NADAX, the strike prices are actually wider than what they are with USD JPY. With USD JPY, the strikes are about 0.04 in width. So you'll have a strike at 80, and then you'll have another strike at 84. Now with JU, you'll have a strike at 56,500. The next one would be now I confuse myself. I think the next one would be like 56,800 or something like that. No, it would be 57,500. Yeah, that would be the next one. So 57. I think that's right. I'm not sure, but I know the don't get me wrong, but I know the strikes are wider. But when the stock or the currency is actually trading near that strike price, that's when it actually gets interesting. So if it's trading right around $20, between $30 and $60, that's when it gets interesting, because when you get those huge pops, you can actually make some good money when it gets those nice pops, because the strike prices are so wide. So that's why I follow that. But I follow all these simultaneously, and then when I need to break it down in time frames, I actually switch over to my, this says 2 screens, it's actually 3. I just never changed it. So here you have my 1 minute chart here, so I can break it down. I can break it down per minute on the 1 minute chart, on the 5-minute chart, I have it here so I can see what's going on. And then here I change these between you know, all different time frames on what I need to look at. You know, dailies, I can, you know, I can switch this to whatever I want. So I mean, I have all my moving averages here. No, not my moving average. I have all my time frames here, so I can switch between the ones that I need. But of course, 1 and 5, I need to see what's going on in the 1 minute, and of course, I want to see what it is on the 5 minute. So that's how I watch that. And then of course, I have my 4x 5 minutes. My 4x 5 minutes is the same as my regular 4x, but these are all 5-minute time frames. So you see here, 5-minute time frame, 5-minute time frames, 5-minute time frames. Look at that 200-day moving average. See how that works? It needs moving average. It works. And this is what I mean by having a lot of different support and resistance levels. I mean, of course, I will clean this up myself, but this is too cluttered. That's too much. You know, sometimes I do go crazy with support and resist levels, but you know, that's for me, and I understand it. So I don't expect you to understand what I just did here. That's why, you know, when you do your own, you'll be able to more understand it. So of course, let me know if you have any troubles on how to, you know, on where to place them and everything. I'll try to help you as much as I can, especially individually. I'll try to help you as much as I can. So that's it with my platform and what I have set up. So you pretty much see my arsenal of what I use, my indicators. I don't use too much. MACD, I really don't use MACD because to me it's delayed. And what I mean by delayed is I have one of these charts set up with MACD. Let me see. No, it's not there. I have to find it, but MACD, for instance, if this was on the MACD wouldn't probably give you a cross until about here. To me, that's too late because sometimes the trend doesn't continue to go down here. So with MACD, it's a little delayed. I need to know when it's going to break here, and your support and resistance level can help you out with that more than MACD could. Because MACD is not going to really tell you when to get out, but your support and resistance levels can actually tell you when to get out. MACD, once it crosses here to go down, about time it goes back up and it crosses, you've already lost money. So I don't like to use MACD because it's delayed unless you actually fine tune it. And I do know a couple of members that actually fine tune their MACDs, and which is great. You can do that. I just didn't do it. So, you know, that's just my personal opinion. So let me show you gold. So I have gold set up here on NetDina. I'm sorry, not gold, oil. I have oil set up here on NetDina. These dotted lines that you see here are the lines that I actually created on my phone. And with NetDina, you can actually look at support and resistance levels from your phone, and it'll actually sync with your computer only if they are alerts. So if you set these lines as alerts, that's the only time that they will sync in between your phone and sync on your computer. Other than that, if I just drew a simple line, it will not sync with the mobile application, only the alerts. So just remember that if you're actually drawing some levels and you're wondering why they don't show on your phone, the reason why is because they're not set as alerts. So let me show you what I'm talking about. I haven't used the computer in so long because I usually just use NetDina on my phone. Nope. Lines. There we go. All right, there we go. All right, so let's say we're placing a line here. So if I just place that line there, that won't show in my mobile application. Now another thing is as well is once oil trades up to where the alert line is, that alert line will disappear. It would, since it's already triggered, it's going to leave, so you'll have to replace it. So you can always do it like this. So you see I put a line there. You can always do another line so you don't lose that one line. You can always place another line there. Once you create your alert, so once you click on the line or right click on the line, set alert on this line, save it. Now I'm going to move it to match up with the other line. Save. So now when I go to my phone, actually this alert line that I put here, I can actually go to my phone and create another line, so that, you know, once that alert line leaves, I'll still have my support and my resistance level there. So that's one way you can actually you know, kind of cheat the system. Not really cheating, but that's one way you can actually trace your own levels. But as you see here on oil, this is where I ultimately wanted to short. I was actually in the morning, I was telling everybody, if it can stay at this high level, I will enter a short position. Here, right around 7:30, 7:45, oil hit its high. And actually, if I can zoom out, you'll see some other stuff. But oil hit its high here. Look at RSI. RSI is over 70. That will be a perfect short if it would have stayed here at around 9 o'clock. So it did not, well, I expected it to stay as high at this high level until about 8:30 or close to 9, but it actually started to drop right at 8 o'clock. So this is 8 o'clock hour. It dropped. It was here. 9 o'clock, it was here. Now theoretically we could have shorted it again, but at this level, see where RSI is, it's below the 50 level, and to me it's a little tricky. It's a little tricky to go short or to go long. So I mean, you could have went in both ways. So you could have gone long and you could have shorted as well and actually came out too. So, you know, that's some things that I will do. If I don't know a direction, I'll choose both directions, and then I'll make money on, well, hopefully the side that wins makes enough money to cover the loss on the other side and also give me profits too. So so that's pretty much about it with oil. Just wanted to show you this chart setup. This is a 5-minute chart. So just wanted to show you this chart setup and look at how it was trending on that 200-day moving average. So so again, I mean, if you have any questions, let me know. This is a long video, about 48 minutes long right now, probably going on 50 minutes. So if you have any questions, let me know. And again, welcome to TWT. You'll see a lot more videos from me, and hopefully I can do some trading sessions and so on. So I got a lot of things that I want to do with this group, and I want you to take advantage of it and learn a lot from me. And thank you.